Markets. Welcome to our weekly webinar. Today we are on, of course, the eternal topic. Seems like forever for the world economy, for the US economy, currency traders, for stock traders, for everybody. What is the Fed going to do and why? It's a topic we unfortunately can't avoid. So we'll deal with it again today. The Fed has been saying for the US Fed, which is essentially because of its size and because of its flexibility and because of its history and its relative independence, is essentially the central banker for the world. What the Fed does has more impact than what any other central bank does. When the Fed decides to flood the world with liquidity, emerging markets go up. Oh, by the way, let me just say, since we're getting started here, I prefer to run these, I think as everyone has heard from me many times, colloquially and also collegially. So if anyone has any comments or any points they'd like to make, please put them into the chat and I will be glad to take some time out and answer them. The Fed has been saying, and the Fed must say, it's been their mantra for God knows how many years, that they're data dependent. Let's kind of leave it up to the rest of us to figure out what that actually means. It used to be that as long as that the Fed retained its use of the traditional role of a central bank, there are two. Well, there was an original one, which of course is the lender of last resort to prevent the system from going bust. But a more modern one is the counter-cyclical one to smooth out the business cycle so that the severe ups and downs are not as severe and the economy continues more on an even path. That's the purpose behind their later impositions from Congress of inflation and full employment. So it's that traditional role, the second traditional role, that the Fed lays into, emphasizes when they say that they are data dependent. They mean that as the economy heats up, heading towards overexertion, heading towards inflation, the Fed will apply the brakes. Prevent inflation from getting out of control, prevent the economy from all sorts of malinvestment, and bring it slightly back to earth. And then the other side, when the Fed sees it, of course, heading to recession, or at least slowing appreciably, the Fed will ease credit and bring the economy back onto an even keel. That's the traditional role of the Fed. And that is what the Fed means and is referring to with this by now rather farcical rhetorical commitment to data dependency. We're going to look at a few charts here today that will show you that the data dependency makes little sense because the data, I mean, as far as judging current rate increases, next week, possibly, and you could say the December rate increase as well. There hadn't been an appreciable amount of change in the data going back at least a year or more. You can take a look right now. That's the non-farm, the one that everyone gets all fatoutsed about. Non-farm payrolls. Well, until recently, now that the Fed's starting to talk up a rate increase again, there was very little change in non-farm payrolls and the production of jobs in the United States. It was very consistent. So there isn't any data dependency relating to non-farm payrolls. There was a little bit more relating to, let's look at the Fed's other, we really do have to improve the visuals in this room. I'm sorry about that. It's one of our conference rooms. Hold on one sec. Let's just bring up the core CPE number. Again, this is the core CPE number. So data dependency, okay. The decline from late 2014 and then the rise. You can make some case that this is related to energy prices. Of course, this is core, so it's not as much effect. But this is moving exactly in the direction over time, more than a year and a half now, almost, that the Fed wants. So data dependency, it would seem we have a predicted start of a Fed rate hike cycle. It's my contention that the Fed has been surprised, their analysts, their economists, by what has happened. Twofold. The idea that, well, there are several ideas, but none of them seem to have panned out. One, that the economy would truly get a boost in growth from low interest rates. That clearly has not turned out to be the case. Honestly, it seems to have very little effect. What you have is an economy adjusting to a new businesses and others, consumers, the two sides of the, I mean, the three areas of spending in the economy are the consumer, often talked at 70%. I have my doubts about that figure. Business and government. That's where the spending comes from. And so that's where the economic activity comes from. And it's all interrelated, but of course, that's what you see. I'm going to check this, the chat here. Okay. So what has happened, and I think this has been a surprise to the Fed, is that with this perennial low interest rate policy, the economy has adapted to the, adjusted, if you will, to the interest rate policy of the Fed. And so much like my contention that zero rates are entering into the quantum world of rates rather than the Newtonian world of normally adjusting rates, the results of the economy adjusting to the zero rates for 7.5 years now, I think has been a surprise to the Fed. And maybe perhaps many other people. I mean, it's understandable perhaps, because this particular experiment has never really been tried, and certainly not for this period. But the result was not because of the Fed. I'm not going to assume that I'm either smart enough and knowledgeable enough or much of an economist to assume what the Fed members would think. I was listening to Dennis Lockhart on Bloomberg Radio on the way in this morning, which was rife with traffic. And the rhetoric, the thoughts are standard issue. It's like listening to government issue talk. Now, I understand that there may be many other ideas that are expressed in the privacy of the FOMC meetings. Nonetheless, what Mr. Lockhart was saying is, well, we're data dependent. If this works out, probably not in June, but maybe after that. This is the same line. They must keep the idea of a rate increase on the table because that's the only way that they can pretend that they're waiting for more data and more information, which I think very much is not the case. At any rate, the Fed's recent approach, or the Fed's approach of data dependency, which I find completely, well, it's getting close to farcical at this point. Because as I just showed you, the data long since justifies. Now, it would be one thing if you were looking at the data, this inflation data and the non-farm payrolls data that I just showed you, and rates were essentially normal, 3% or something, or 4%, or whatever you want to say on the 2-year, just as an example. In that case, without any great acceleration, except the recent increase until the last reporting month of core PCE, you wouldn't have necessarily a case for raising rates. The economy does not appear to be accelerating. Look at GDP, it's not accelerating. It's pretty much on an even keel. You can make lots of arguments that because of the lack of wage growth and everything else, it needs more help or it needs more freedom. Something else is warranted. But you can make the case that if rates were normal, that there's a pressing need to rein in the economy. That is something you cannot do. The real case for raising rates relates to their level and not to the economy. The reason the Fed is so desperate, and they are desperate, to raise rates is because because the Fed funds rate is 0.75%. It's not because the economy is strengthening like gangbusters and the Fed needs to head off over excitement. But by making themselves data dependent, rather than simply saying, you know what, the Fed's rates need to go up because the rates at zero bound are distorting the economy and they shouldn't be here. And they're creating more problems than they fix. Well, the Fed can't say that. The Fed's not going to say that. So they're forced to fall back on this endless repetition of data dependency. Get it? Everyone needs to, I think, understand that the interpretation of Fed policy is not necessarily a function of Fed rhetoric. At any time. I don't think it's necessarily more true now. Well, it is more true now. I take that back. Than it was, say, when Alan Greenspan was chairman, or when Ben Bernanke was chairman, at least the first term. Because when Mr. Bernanke was chairman, the overriding goal was to prevent some sort of debacle. And all of the policy moves and policy justifications were aimed at that. The problem we've seen, of course, is that the continuation of these policies have become a problem in themselves. Okay, so back to the Fed's data dependency. So the Fed is no longer data dependent, because if it was data dependent, they would have raised rates. Because remember, we're dealing with two things here. We're dealing with the economy and with the bizarre continuation of the zero rate policy. So we can discount the Fed's incessant talk of data dependency. Data's been there for more than a year now, at least for 6 months. And as far as non-farm payrolls go, more than almost 2 years. So we're back to another question. What is going on with the Fed? Well, it seems to me, as I wrote in the write-up for this webinar, it appears that the Fed policymakers have stopped looking for economic improvement as the condition for higher rates. At least any economic condition beyond the 2% growth and probably the 200,000 average that we had in non-farm payrolls. Now, many of those jobs, remember, were not full-time jobs. They were not well-paying jobs. They were not the kind of jobs that provide people with the amount of income to commence the virtuous upcycle in the economy. Nevertheless, the Fed has been touting them and quoting them for how long, as has the administration, because they don't have anything else. The unemployment rate, as constructed currently and used, the U3 rate, should be abolished because it gives a totally false impression about what is going on in the economy. It gets cited and it makes no sense. You supposedly have an economy at full employment or very close to full employment. Almost no wage increases until lately, very recently, no burst of retail spending. It makes no sense, and that lets you know that the GDP is going nowhere, 2%. So it lets you know that that particular statistic is of little utility in this current world. So what we're seeing is an economy restrained more by low interest rates than promoted. And I think the Fed is realizing this, but they can't come out and say it, because that would undermine both everything they've been saying and what little credibility they got left, they have left, excuse me. Hold on one second, folks. I just want to find out from, 1 second. Okay, let's keep going here. I'll make sure the chart is still up. Okay. Make sure everybody else is still here. The Q&A link is disabled. Why is that? Okay, just to make sure. Oh, here we are. Okay, let me put the chart back up. Okay, there we go. We have the PC chart. So we have this rather profound shift in Fed policy, and what's determining Fed policy. Instead of looking for the economy to improve, the Fed is hoping that things don't get worse. This is a very different approach. Now, the Fed is not going to say this, but their actions have everything to do with confirming it. If the Fed was data dependent, this was the FOMC and its inflation they were concerned about. Remember in March, which is over here, and in subsequent until the past 2 weeks, was the March minutes that seemed to reverse the rate stance. Say that we're now concerned that things are getting worse or that we can't raise rates. And so we're letting everyone know that that's no longer our view. But the data supported a rate hike. Let's look at non-farm payrolls. Again, okay, non-farm payrolls. So this is the December meeting right here. Did the Fed anticipate this? My guess is absolutely not. And the reason is because the last non-farm payrolls we just received last Friday, 38,000, and the downgrade to the prior month, 123,000. A week and a half before that, half the voting members of the board were out there saying we need to raise rates. We could still raise. June is live. I'm live. We're all live. July is live. If the Fed had no intimation of that non-farm payroll report on Friday, it makes no sense that they would have, if they had prior notice or prior warning that this is where the figures are going, it makes absolutely no sense that they would be out there saying, we're going to raise rates again. Because it just makes them look like they don't know what's going on with the economy, which I would make a case that they don't know what's going on with the economy. These are not very well. So as far as the Fed knew, all of the economic indicators, the data dependency rhetoric was fulfilled. And this is true going back for more than 2 years, certainly as far as non-farm payrolls go. Since the beginning of 2015, payrolls were averaging were ranging between 281 and 190, and they were averaging 225 and then 225 in 15 and 251 in 14. That's as good as it gets right now. The core PCA moved down and then it moved up, but relatively speaking, it was moving finally in the direction that the Fed wanted. But the Fed did nothing till December. The PCE has since fallen off, and much more worryingly for the Fed, 3-month moving average for non-farm payrolls dipped down to 116,000. Now, you know, there were warnings of this. The ISM figures, the Institute for Supply Management, on employment, both in services and in manufacturing, have been pointing to a decline. Not only that, has everyone, including the Fed, forgotten Q4 and Q1? Average at currently 1.1 GDP annualized for 6 months. That is about a breath and a half away from recession by the standard and probably outmoded negative GDP quarter to quarter. As everyone knows, as the Fed knows, as I know, as you know, employment's a trailing indicator. What does that mean? It means that employers are reluctant to fire and reluctant to hire. It's the last thing that they will do. Despite what you hear from much political rhetoric, businesses don't like to fire people. A friend of mine runs IT for down on Wall Street for a big financial services firm. And he just had to let go a whole bunch of people. And it's not fun, it's painful. What tends to get glossed over in the reports, the media, the political rhetoric, everyone trying to make a point for their own side, is that it's someone sitting down behind a desk saying to someone else, you've lost your job, clean out your desk. That's not a pleasant thing to do. So firms are reluctant to fire people, and they're reluctant to hire people. They don't hire people until they see the prospects of business. When their current employees, either through talent, either through skills or through numbers, simply cannot perform efficiently the roles required of them. So if the economy is running at 1.1% GDP for 6 months, what effect is that going to have on the potential jobs being created? This is not hard to figure out. What are firms going to do? Well, the first thing they're going to do as far as the employees go is not hire anybody new until they see better sales, until they see better business environment. That's what they're going to do. They're going to not hire. What's the next thing they're going to do if it continues? They're going to start firing. This is not a difficult progression to imagine. It seems to have eluded the Fed. And again, I don't mean to imply that the Fed is composed of second-rate people. I don't mean that at all. I don't mean that in any level of government, really, certainly not on the management levels. Yet there seems to be a very, very strong inherent bias in the Fed's economic analysis and in the Fed's judgments. A wish fulfillment, almost, that these things will be true because we want them to be true. This is the best case I can think of it, is the difference between what was to myself fairly evident as far as the potential changes in the economy and in the statistics that the Fed is looking at in the next 6 or 8 months from the third and fourth quarters of last year, especially when you saw that very dramatic slowdown. Now, there is a problem in my mind, and always has been, with GDP statistics, the way that they're divided up quarter to quarter. I mean, does the economy suddenly falter, fall apart? I mean, 0.8% is essentially falling apart from 3% or a little more a quarter and a half ago. So how it's divided up with those dividing lines between quarters always seems to be pretty artificial. So nonetheless, there was clearly a change in economic activity in the United States in the past 6 months in the third, in the fourth, and first quarters. The idea that this would not have a profound effect at such a large change on the statistics that the Fed is watching seems to me to be beyond naive. So what does that tell us? That the Fed didn't figure this out? No. It is not my intention, nor is it my thought, to imply that what I've just said here wasn't even more apparent to the Fed, to Fed analysts, and to Fed governors. I can sit here in Woodcliff, New Jersey, and come up with these ideas. God knows the Fed can too. So why then would the Fed come out 2 weeks ago and start talking up a rate increase? And here we get back to the idea and the difference on Fed motivation, what's driving the Fed policy at the moment, between data dependency and normalization. And this, I think, is key to understanding what is happening both with the economy in the United States and around the world, and central bank policy. It's clear, as clear can be, that the Fed is not data dependent. Let me pull up another chart here. This is the S&P. And I have another chart about this as well, at least as far as the Fed's attitude. I think that it has dawned on the Fed, and perhaps the other central bankers, of Mario Draghi seems a bit impervious to this, and the Japanese, I don't know what's going on with the Japanese as far as figuring things out, but it seems to have dawned on the Fed. I give them credit for this because it is not a theory. I mean, I heard on the way in this morning, I heard some opinion piece on Bloomberg. And the guy was talking, well, he was saying, it was a very short piece, that the current situation, economic situation in the United States, cries out for further stimulus. And I was thinking, how hidebound can someone's thinking be to look at the past 7 or 8 years and say, we need more stimulus? What is a zero rate policy for 7 years except the apotheosis of stimulus? And has it worked? Can anyone look around, including the Fed, although apparently not this man? I do remember his name, but there's no point in bringing it up. I believe the piece is on Bloomberg today, if anyone has on the Bloomberg site, and say that this needs more stimulus. It's clear that interest rate stimulus beyond a certain point and to a certain level does not work. The old, they say, what are you going to believe? What I tell you or your own lying eyes? Well, here we have in front of us an economy that has been stimulated to death, and it's no longer working, if it ever worked at all. But it is clear that in the years ahead of us, theoretical economists are going to have to re-examine the idea of the linear relationship between growth and interest rates. It's been my contention for a long time that when you artificially distort, and this is not only my idea, this would be almost any of the Austrian economists, that when you distort as basic a entity as basic a factor in an economy as the price of capital, then you distort everything else, and the economy no longer performs or no longer responds the way it does. So the Fed data dependency is a smokescreen. What they're really saying and have been saying by their actions, not their words, is that as long as the economy doesn't get any worse, we're going to raise rates appreciably worse. How much appreciably? I don't think they know. But there are a couple of signposts, and none of them relate to statistics. Not quite, anyway. If the non-farm payrolls, last Friday, had been 160 or 200, if we had returned to the average of the past 2.5 years, then I think we could all be assured, as far as these things are possible, that we would be getting a rate increase. Just 1 second. I just want to make sure that the chat is available. Sorry, folks. Just want to make sure the chat's available for a minute. I don't. Okay, I'm just asking Adinda, who does the logistics on this one. Okay. So the Fed is no longer data dependent, except in the fact that, meaning that they're no longer waiting for the economy to improve. Because the economy has improved apparently as much as it's going to improve under the artificial zero rate policy. This apparently has finally been figured out by the Fed. There are a lot of other people saying this for a much longer time. So the Fed now wants to be sure that nothing else gets worse. Now, what are we talking about? Up until Friday's non-farm payrolls, I think they had a reasonable assumption, at least they had a reasonable hope, that the economy would continue on an even keel and not get any worse, not get much better. We haven't seen that. And so they could go ahead with their normalization policy. The things that they were concerned about was this. If anybody thinks that's not, those two are not connected, then I don't know what to say to you. The Fed raises rates on the 16th, and look what the S&P does. A bit of a delay, but it crashes. Look at another issue. The other, I think, big issue for the Fed. China. The fixed value of the Chinese yuan, the onshore yuan traded in Shanghai, At least Shanghai's where the major exchanges. Look at what we see. When the Chinese started seriously devaluing the yuan, which they have started to do again, is anyone missing that second red arrow pointing up? It got very close to the highs back in January, and then it fell off again. But look at the area here. What does this look like? Well, it looks like this, and to a smaller degree, this. I know there are people out there, and I've read them, saying that the government in Beijing is deliberately giving the Fed a warning. Don't raise rates. I've spoken to a number of people that I know here in New York who have relatives and family and friends on the mainland. And the reports I'm getting are considerably, now these are anecdotal reports, of course, but the one thing that seems to be constant in these stories I'm hearing are the unease and the concern in the mainland, which doesn't really get translated back. I'm dying to go back to China. Haven't been there in almost 4 years now. And to get out of Beijing and get a sense in the countryside of what's actually going on. But one of the things that you've seen is that people are very concerned about a devaluation of the yuan, and they're trying to get their money out of the country. And I'm not talking people with a couple $100, I'm talking people with millions and billions. It's what's driven some of the West Coast real estate market, some of the crazy stories you hear from Vancouver and other places on the Canadian West Coast, the real estate market in San Francisco, and several others. To get the money out of the country before its buying power overseas for goods, because it's still true that luxury and high-end goods in China are largely products not of China. They're imported products. Cars and everything else. So, and this is kind of standard in the development process of many economies. There's nothing unusual about this. It's not meant to be a criticism. It's normal. Nevertheless, if people want these things and want to spend their money on high-quality goods, they're afraid of seeing their buying power diminished by a devaluation of the yuan. And if you look at this chart, does that look like a devaluation of the yuan? It doesn't look like it, it is. Now, China is not going to come out specifically and say to the Fed, you raise rates, we're going to devalue. What they're going to do is they're going to devalue and let the Fed come to its own conclusion. And they may be telling them this in private as well. So back to data dependency. It's not the data dependency for an improving US economy. It's data dependent in one sense, as long as things don't get really bad. Or shall we say, things don't get appreciably worse in the more measured tones that we like to use to speak about the economy. Appreciably worse. Does a 3-month moving average in non-farm payrolls, the statistic of our particular age, it used to be international trade in a prior age, almost halving in 4 months, 5 months, meet the standard of appreciably worse? I would say it does. It has certainly changed the market's view. Before non-farm payrolls, when I wrote up this webinar, and I'm just looking for the statistic here, the odds for a June hike, this was published on June, when did I send this out? 2 weeks ago. Okay, so just after the Fed had started talking up the rate increase from the Fed governors about 2 weeks ago. The odds for June hike on May 26th, so a little bit less than 2 weeks ago, were 33.7%. My guess is they went up after that to almost 50%. Not my guess, I know they did. And 57% for the July 26th meeting. You know what they are right now, as in this morning? 7.2% next week. Higher than 90% no interest rate. That no interest rate hike, that's what the market is saying. So if you have Dennis Lockhart out there this morning, he's Atlanta, I think he's voting, that the June meeting is live. Well, it's live in the sense that they're all going to be there and they're all going to be alive and there's going to be a real meeting. That's about the only sense that that meeting is live for a Fed rate increase. On July, the rates were close to 60%. What are they now? 31%. My guess is they go down further. The only meeting where there is, well, there are two, both the November and the December meetings. The November currently this morning was 49.6, so 50% even chances, and then it went up to 60%, 59.4 for the December meeting. This is where we are. The Fed's data dependency is no longer, and hasn't been for some time, because if the Fed was going to raise rates, as I've said, we need to change, because what's important for us as traders is to make a realistic assessment. The markets did this on Friday. What happened to the dollar when non-farm payrolls came out? It got pummeled. Euro went back above 113. I hope nobody was short, the euro that is. The yen went down to 106 and then came back a little bit. So that is the realistic assessment. Data dependency not based on an improving economy. Because if we had gotten standard issue non-farm payrolls, that means between 150 and 200, that would not have happened. So it's not based on an improving economy. Forget that. It is based on an economy not getting worse and equities and China not dumping. These are the data points that the Fed is talking about. They're not going to come out and say it, but it doesn't matter what they say. It matters what they do and what their analysis is looking at. As a matter of fact, let's just take a few more things, a few more charts here to back this up, okay? Remember where we are with this, okay? Now, remember, this is the period leading up to the December 15th rate increases. ISM manufacturing, right? The Purchasing Managers Index. Sentiment index largely, not entirely, but largely. So the period while the Fed is talking up rate increases, they finally do. What is going on here? Manufacturing is collapsing. Does that look like a data-dependent Fed? No. They didn't pay any attention to it at all. Here's another one. Retail sales year on year. I mean, this goes on and on. But we might as well do it because it's fun. Okay. Look at this. From mid-1914 on, 2014 on. What are retail? This is year-on-year retail sales. What's going on? Whoops. Whoops. And this is the period where they're leading to the Fed's rate increase. Does this look like an economy that's getting overexcited? No, clearly not. So data dependency works as nonsense on both sides. Let's look at this one. Another one, factory orders. Okay, factory orders from 2014 on. Did I miss something here? Did any of us miss something here? this is the period where the Fed is talking up a rate increase, leading to a rate increase right here. Do you think the Fed raised rates in December 15 because of this recovery? I don't think so. So again, we're looking at the data dependency as the Fed keeps saying they should drop this because it's nonsense. It's not what they're doing. Next one. Industrial production. It's a little repetitive here, sorry about that. All the charts kind of look the same, don't they? Industrial production, what do we got here? Same thing. Da, bum, bah. This is where the Fed raises rates, right there. I mean, right down at the bottom there, the year-on-year industrial production. So what exactly is the Fed talking about? Why would they start talking up rates at this point right here? It's a good question, and I'm going to supply an answer because that's my purpose. Sorry about that. It's a twofold purpose. I've dwelled upon what the Fed is dealing with. And remember, this is important because it is important that we all pay attention to what is actually going on. The Fed, like China, like many central banks, they have their rhetoric and then they have their actions. You must go with the actions. When Alan Greenspan was chairman of the Fed, he didn't give you any clues, any rhetoric. He didn't believe in transparency. He believed in obfuscation. He believed in being coy. So you didn't have to conflict. You didn't have a conflict between this transparency idea based on data dependency, which is clearly not true, and Fed actions. Greenspan never gave you any clues to what the Fed was going to do. So when they did it, there was no conflict. Well, there's a huge conflict now between data dependency. Sorry about that. I wish I had a more acting training. I could do better voices. Data dependent. Whose voice would I choose for data dependency? I don't know. To think about that. You have to make it nice and portentous. Maybe Vincent Price or something. You have data dependency, and then you have what the Fed's actions. Their actions have zero relationship to data dependency. They raise rates when the economy is worsening, and they are afraid of raising rates because of non-data dependency, at least not the economic dependency, because they stop talking about raising rates and start, to put it colloquially, freaking out in February and March. But in February and March, the indicators that were declining continued to decline, being ignored all the prior. And the ones which they were talking about being positive, non-farm payrolls, hadn't changed. So they're not talking about data dependency. They're afraid of market reactions. And I think the psychology behind this is very substantial and very clear. If the economy was strong here and around the world, then the underlying strength, I mean, I saw some CNN article on Monday maybe, that the non-farm payrolls belie the strength of the economy. This is such nonsense. Because had it been otherwise, had the report come in much stronger, the author would have said the strength of the economy is supported by the non-farm payrolls. You can't have it both ways. That's just silly. So I think the Fed is very seriously concerned, and they have shown this time and time again about the parlous state, the very, very weak state of the world economy, so much so that an S&P level that you're looking at right there bears almost no relation to the US economy. You would say the same for the Dow rate. So if the underpinnings of this right here. You know, the Fed's vaunted wealth effect, which, as I've mentioned in several other webinars, is also whatever effect there was in the beginning is gone. I don't believe there is any wealth effect. It's like the economists touting how the decline in gasoline price is going to spur a huge burst of spending. No, it's not. You know why it's not? And it didn't. And I said that it wouldn't all along, and so did many others. It's because consumers are far smarter than the economists, in the sense that they know gasoline prices are going to go back up. They'll rely on their experience rather than a 2-month decline in gas. And what have gas prices done? They've gone back up. How is it that the consumers know this and the Fed doesn't? What do the consumers do? They went out and had a couple of more dinners, eating out, which everybody enjoys, and I live in Manhattan, so it's, you know, what we do. But nobody made any new commitments, long-term commitments, based on a decline in gasoline prices. It would have been dumb. And so no one did. So you got no huge burst of spending. Apparently, a very sensible, common sense approach, which escaped all of the economists and Fed members who were looking for this. Okay, so the psychological effect of a serious decline in equity levels, much like the economy supported but really prevented from growing by low interest rates, putting a cap, not a floor. The same problem is here. The equity level is not supporting, it's not promoting economic growth. The evidence is everywhere. The wealth effect, no dice. But what remains true? A collapse here could probably seriously damage, because it will get huge media play. Everyone will start screaming. Wall Street will start freaking out, and it will have a negative effect on the economy, which is essentially so weak that it would probably put the economy into recession. That's what the Fed's worried about. And as a corollary of that, if we don't raise rates, we are living on borrowed time, because the Fed has not abolished business cycles. There will be another recession. I can guarantee it. And what do we do? What does the Fed do? When everybody starts clamoring for the Fed to do something, if people would be a lot less dependent on the Fed, and the Fed, of course, has made, apparently the one thing bureaucrats can't do is not act. The one thing they can't do, can't prevent themselves from doing, is doing something. Much of the time, they should probably do nothing. Because if they do nothing, then the economy will have to work it out, and everyone who's out there as an economic actor, you and I and everyone else from top to bottom, will have to work it out. And the things that need to happen will happen. They're not happening. The Fed's preventing them. Okay. So if the Fed doesn't get rates higher, what are they going to do when the next recession hits? You know, I think this is on their minds. It's definitely on their minds. So I wrote a column about 2 weeks ago that was published in a number of places on the web. And I said, is the Fed conducting an equity test? That's exactly what they're doing. They are wanting to see, they are trying to see, and so far it's been successful, if the stock markets, if the equity markets and the global environment, including the yuan level, renminbi, can withstand another rate hike. So far, it seems to be working. I'm pretty sure the Dow was up today when I came in. I didn't actually check. So the Fed is conducting an equity test. What have they done? Let's recap. They've lowered the bar. They're no longer, as far as data dependency goes, which, first of all, eliminate data dependency. They're not data dependent. They are fear dependent. They are watching the markets. They want to see if the economy worsens, not if it gets better. It's not getting any better. They want to see if it worsens. That's their first bar. The second bar, are equities and other markets going to start freaking out and collapsing if we raise rates? So far, they're good with that too. And third, I would say the third bar is China going to seriously devalue the yuan. The problem is, to have all three of these things go on to your benefit doesn't seem to be possible. When the data, quote, payrolls was good, they didn't raise rates because they were worried about, my guess is, China and equities. Okay. Now that equities are back reasonable levels, not quite where they were, not to the peaks, which is probably better, because anytime you get a market to a peak in an environment like this, everyone immediately starts looking over their shoulders, and rightfully so. And China has devalued yuan appreciably. Remember what's going on. Where's my yuan, my renminbi? Okay. China has appreciably devalued yuan almost to the level that they had before, where everyone started freaking out. But this time, the markets are not really paying attention to it. They're not caring that much. This is kind of typical of markets. Markets have a tendency to look at the new thing and not to pay any attention to the old thing. So you have this very profound, deliberate devaluation of the yuan, and nobody's paying any attention. Cool. So another thing the Fed doesn't have to worry about. The Fed doesn't particularly care, I don't think, that China devalues the yuan. I think they care about market reaction to it. Okay? So we have both things that the Fed is hoping for. No equity, from very, very serious and deliberate talk about raising rates in June that the Fed was doing over the past 2 weeks. Deliberate. All right? Everything the Fed does is deliberate. They're not out there winging it away. So you have equities resilient, not freaking out. You don't have to drop freaking out. It's not a technical market term. And markets not, China's devaluing the yuan, but markets also are not reacting to it. Unfortunately, the Fed's gamble did not pay off. Because those indicators I showed you earlier, industrial production, factory orders, ISM, those indicators, which were clearly, and GDP, which were clearly pointing to a decline, a likely decline in employment. Not firing, but in hiring, in new hiring, were true. But the Fed couldn't do anything about them. So they were hoping that they'd get a couple of more months out so they could maybe raise rates in June and maybe in July. Let's see. Okay, so let's sum up here where we are and what we've seen. Data dependency for the Fed. No, not in the terms that the Fed talks about it, meaning that waiting for the economy to get better. Nonsense. Proven from just looking at the charts and what's been going on. Data dependency as far as the economy not getting worse. Yes, I think that's probably true. Data dependency as far as equities. Yes, I still think that's true. Had the serious talk over the past 2 weeks prompted of a rate increase by the Fed governors, prompted a equity swoon, I think we'd be in a different place. Same for China. Had the talk, which did prompt a devaluation of the yuan, prompt reaction in Western markets, I think you would have seen a reaction to the Fed as far as rhetoric goes. So there we are. The Fed's data dependency is not true. Their concerns are definitely true. And again, if the economy, the Fed is still in the same box. They are waiting for too many factors to line up. Factors over which they don't have a lot of control. Let me put it better. They don't have any control. The Fed can, at this point, if the Fed sees declining GDP and declining employment, what are they going to do? Where do they go for their stimulus? Do they start QE again? It didn't work very well anyway, but what else are they going to do? They're going to retract the quarter-point December rate increase. What difference is that going to make? It's not going to make any. In fact, if the Fed does anything to stimulate the economy, everyone is going to enormously to worry much more than they were before. So the Fed can't stimulate the economy. It wouldn't do any good anyway, but they can't do it. And they can't raise rates because they're afraid that that will damage the economy. Their fears for equity and for China-based equity moves are not materializing. The markets are probably bored with that one because we already saw it, so they're not doing it. But now, unfortunately, the Fed was waiting for all the economy had to do was stay stable, but it didn't. So the Fed can't raise rates again. They're not going to raise rates in June, and I doubt very much they'll raise rates in July. Okay, folks, I thank you very much for attending, as always. I take it as a great compliment that people take time out of their day to listen to what I have to say. I will. And anyone has any comments, criticisms, or anything else, please let me know, and I'll be glad to answer your queries. Again, thank everyone at FX Street for the facilities to do these talks. I do enjoy them greatly. Thank you all very much for attending. Take care.